everybody, Luke Gromen, FFTT. Hope you're well. Hope you had a great weekend. I know it was started off a little iffy on the weather, but ended up being a beautiful weekend and very nice day yesterday. Hopefully it was nice for you as well. So with that, thank you for joining me. I'm going to jump right into the questions. Thank you for submitting them. Always great to see them and think about them. It's very helpful, so thank you. So with the for the first question, Gary, please comment on the significance and policy implications of comments by Bank of Japan Governor Kazuo Ueda today. Is it simple jawboning or does it imply near-term policy changes? I don't know if it's just jawboning or if it is near-term policy changes. I do think it implies an increasing level of discomfort. I won't go all the way to panic, but discomfort amongst Western policymakers regarding what is happening in global sovereign bond markets and in global currency markets, in this case the yen against the dollar and the weakness. Ultimately, whether it's jawboning or actual policy change, it'll likely put more upward pressure on global capital costs. In other words, yields up in treasuries, EU, Japan, basically regardless of what inflation's doing. Keep in mind this concept, this net international investment position concept we've been discussing and hammering on. It continues to be not focused on enough by most market participants as best we can tell. Whether it's jawboning or an actual policy change, certainly the widening of JGB, 10-year JGB yield curve control band a little over a month ago was a policy change. It is Japan saying we are going to repatriate Japanese capital from abroad to finance more of our fiscal deficits and or defend our currency. With Japanese net international investment position at a positive roughly 60% of GDP last time I checked, this amounts to a piggy bank of 60% of Japanese GDP that can be repatriated back to Japan to buy them time. By them doing this basically throws the problem onto the lap of the Fed immediately. In the form of higher treasury yields, despite whatever else may be happening, disinflation, deflation, etc. So let's watch and see what it actually amounts to, but directionally it is further repatriation of Japanese capital from abroad, quite possibly. From Frank, will the U.S. eventually have to cut entitlements as predicted by Stan Druckenmiller? In my opinion, yes. The key question is how. Will they cut them on a real basis where we have high sustained inflation, which I think is probably the most likely way of doing it? Basically, you get 10 to 15% CPI actual inflation, and you get the cost of living adjustment for entitlements to be 5 or 6, and you do that long enough and you can sort of reduce the real value of those obligations. Can you do it on a nominal basis? That's the second possible way, where you just go to the baby boomers and say, sorry, we're going to have to cut your benefits by 30-40%, which I think is around the number that Druckenmiller has talked about as needed immediately. It's possible maybe you can do some phasing based on income levels, right? So means testing for higher income beneficiaries, and you cut them 80, 90%, 100%, and you keep it for the more the people who need it more. Any way you slice it, that is a very politically fraught dynamic, no matter how you handle it. And in an election year, I just don't think it is going to be possible. So for at least the next 18 months, I don't think that a nominal cut to entitlements is possible. There's one other way that nobody wants to talk about. It's not something I'm rooting for, but as an objective analyst, I need to keep an eye out on the data to see if it's happening. And that is if some good percentage of the sickest baby boomers who when you look at the data, account for a very disproportionate quorum of overall entitlement costs. If they pass on relatively quickly as a cohort over the next 2, 3, 4 years, 5 years, that fixes a big part of the entitlement problem. That is a cut to entitlements. No one wants to think about it that way. I don't even like talking about it. I'm certainly not rooting for it. But again, as an objective analyst, I need to keep an eye out for it. We all need to keep an eye out for it because it would represent a de facto productivity miracle. You would significantly reduce the U.S. government's outlay on entitlements. And you would also actually pass on that cohort of boomers' wealth, whatever exists, onto their kids who are in their higher spending years of life, just based on demographics. So you will go from a big fiscal drag being removed and a GDP accelerant accelerated by virtue of the wealth of that cohort being passed on to their kids and spent into the economy. So again, I am not rooting for it. I'm also cognizant of the dynamics. I'm watching for them. I'm not seeing them yet, but we'll see going forward. From David C., will Lagarde lose control of the spread between German bunds and U.S. treasuries now that German industrial output is faltering? How does the ECB cope with the exodus of capital across the pond as Powell stays higher for longer? I don't know. The EU's in a tough spot. It's been the biggest surprise to me over the last 18 months how much the leadership of the EU has acted against the interest of the EU at the behest of U.S. policymakers. It is now resulting in the severe deindustrialization of Europe. Energy costs are going to be non-competitive, and that assumes the U.S. does not cut energy costs, LNG exports, to the Europeans sometime over the next year, where if inflation picks back up here, reaccelerates here, energy inflation in particular, I am not convinced that the U.S. administration in an election year will continue to ship energy to the Europeans in the quantities promised, at the costs promised, if doing so increases inflation here in an election year. And so I don't understand the game the EU is playing. Now, the capital repatriation is a little tricky. On one level, you are seeing industrial capital move here, from there, based on energy costs, etc. On the other hand, Germany has been running surpluses for a long time, and they are subject to the same net international investment position where they likely have dollar assets sitting here they can repatriate that would go in the other direction. I don't know how those things net out. I apologize. So that's one of the things where probably need to look into a bit more to see what is Germany's net international investment position and what does that look like. Can they start repatriating, which again would simply increase global capital costs, throw the problem back onto the lap of the Fed, increasing treasury yields almost regardless of what's happening with inflation in the economy, which simply makes the instabilities we've been seeing over the last 18 months more unstable. Next question from Bert. If the BRICS countries go back to some form of gold-backed currency, will countries like Saudi Arabia accept the dollar or euro as payment? Do they insist on being paid in gold? I don't think the BRICS are going to a gold-backed currency, as it were. I think what they're doing is they are switching to more local currency transactions, particularly around energy and other commodities. And then any net surpluses that exist. At first, if there are imbalances that build in a local currency, those local currency surpluses, which will tend to be amongst the energy exporters, the commodity exporters in the group, can then be recycled into the production of the energy importing net creditors, factories of the world like China. So if Saudi ends up with yuan on their books at some point, like the Russians have ended up with yuan on their books, the Russians can recycle those yuan into Chinese goods, as could the Saudis, and then whatever is left over will be net recycled into gold at a floating rate in all currencies. And as a practical matter, quite possibly at a higher gold to oil ratio than the paper market set gold to oil ratio we see in London and New York, which as a practical matter would mean that a lot of that gold for settlement for BRICS local currency trade net surpluses would be coming from the West. So that's what I think that system is evolving to, not an explicit gold-backed currency, because nobody wants those kind of handcuffs on them. They just want a reserve asset that won't collapse over time against oil and against other commodities, which is what treasuries, bunds, JGBs, all global sovereign debt is highly likely to do in coming years. Gold won't collapse against commodities. Gold will maintain purchasing power in commodities as it has for well over a century, unlike all Western sovereign debt. And finally, from Mark, what is your view regarding liquidity in equity/Bitcoin? How close is the correlation? What measure of liquidity do you use? For me, Bitcoin remains the last functioning smoke alarm in terms of a measure of liquidity. A lot of other markets are shall we say, managed for various political reasons. Not to say Bitcoin is completely unmanaged. I think there are certainly forces that would like to try to manage it, but I think it's a cleaner market than almost all other markets at this point still. And so for me, it has a message for liquidity. Now, what is liquidity? I think it's multi-pronged, if you will. Higher oil prices drain liquidity. Higher dollar drains liquidity, and vice versa. Higher Treasury General account. So if the Treasury is building up the TGA, drains liquidity, vice versa. Higher rates, all else equal, drains it. Sort of. Remember, we've been highlighting this dynamic with really inspired by work by Charles Calomiris and by Warren Mosler. Higher rates with debt to GDP this high aren't as unstimulative as they used to be as time goes on. They start creating interest stimmy. So higher rates kind of drain it. It becomes a netting game, right? So initially, higher rates probably do drain it a little bit on net, but the longer it goes on and the more they go, the more there's an interest rate stimulus to wealthy asset holders. And when you net that against the deficit stimulus of that, against the fiscal deficit stimulus of that, against the private sector curtailment of activity from those higher rates, I think we're getting to a point where it's net stimulative actually on higher rates. So I also like watching the MOVE Treasury Index volatility. It hasn't returned to highs. The dollar, DX, as measured by DXY, is also a good liquidity indicator when factored in with sort of all these other factors. And there's some firms that do a really good job of looking at liquidity. I know Cross Border Capital, Michael Howell, has a pretty active Twitter feed and a research service looking exactly at liquidity in great depth. He does a really nice job. So with that, I'm going to sign off for the night. As always, if you like these updates, check out FFTT-LLC.com for more information about what we're up to, where we're at, and information about our Tree Rings product, 10 most interesting things, what is grabbing our attention about each of those 10 things, whether it's confirming or refuting a way we'd previously been thinking about the world across a number of different topics. So with that, I'm going to sign off. Thank you as always for joining, and I look forward to chatting with you all soon. Everybody have a great week. Take care.